Another one is here. We have the imbalance here after we aggressively moved lower and then retraced back up in. This is why I'm saying that that previous short, if I was short from here, I wouldn't be worried about this one so much because your stop would be above here. Now, it got close to it, but I've been in many trades over the years where it moved within a quarter of a point without stopping me out. And it's a scary feeling, especially if you have a lot of size behind your positions at the time you're in the trade. But it's still a little intimidating because if you completely fulfill your model and follow it in all the rules, and you don't want to move your stop and you just allow the stop to be taken, there's been many instances in my own trading where within a quarter of a point, it doesn't stop me out. It's not like Forex. These markets are a little bit more professional in the sense that they're much more precise and uniform in the delivery. You don't get these wild, erratic little spikes and spreading, of the price action because everybody's working with the same price here. Versus in Forex, you're trading within a pool of liquidity within your broker's in-house. And they have a little bit of luxury there where they can open that spread on you. And that's why it's a little bit trickier to operate in that versus something like this market here. It doesn't mean I don't love Forex still. I do. But right now, Forex is just quiet. It's not doing things that I would promote in my students' attention. I'm telling all my students, both in my private group and you all here, that this is the markets that you should be following. These markets right here, the index futures. I'm sure there'll be a time when we transition from index futures back to Forex, but until I see them loosen up a little bit in the currencies, my attention is here. This is what you're looking for. And when you do your back testing, I've got a lot of questions in the comment section about this as well. You go through your charts, just like I'm doing here, and you annotate them. Now, in all these areas where there's empty space here, or over here, or over here, you're putting in little notations and you're typing them out. And yes, it takes time. Yes, it's tedious. Yes, it takes a great deal of effort and desire. But this stuff rewards that. It rewards it. It's not like fantasy football where, who cares if your team wins? This pays you. This is something that you can feed your family with, okay? If you need your expenses to be reduced and you don't want to get another job, or you take a pay cut and you get a job loss or whatever, this skill set can fortify any weak links in your financial chain. Okay, you want to build strength in your ability to make income and build legacy wealth. It's worthwhile for you to spend time learning this. And that means going back through old charts and old moves and literally going in and annotating the moves like this and mapping them out and seeing the logic that's there. Now, do not be afraid that you're going to do it wrong. All of you are going to be doing it wrong in the beginning. This is a skill set in backtesting you're trying to discover, okay? You're not trying to do things correctly in backtesting. Backtesting is you in a mode of discovery that proves efficacy. If you can't see things repeating, then you got to go back into the core content lessons of this YouTube channel and ferret out what it is I'm teaching conceptually. Then once you understand better what it is I'm showing you, then you go back into the old data and look for those very things occurring. Then highlight the things in your chart that makes the most sense to you. Over time doing it, and frankly, you should be doing this at least a minimum of a year. Okay? Make it a practice of doing it all the time. Even when you start trading with live funds, your trade journal should always have annotations. You should always have charts saved and just constantly referring to what you witnessed in price and record it like you saw it happening and knew it was going to happen in advance. That's called self-talk. Okay? You're literally tricking your brain into seeing your annotations as something that you foreseen coming. And that way, when you go back and you read your journal and you study it on the weekends or whenever you go through a period of drawdown and you need encouragement, you go back to your charts in your journal and you'll see annotations that you wrote out yourself, and it tricks your brain into believing that you've seen that all along. Now, what happens by doing that over time is you have created creases in your brain where that knowledge and that pseudo experience has been retained. But your brain remembers it as what? A real experience that you endured. But you're recording it with positive reinforcement in your commentary. Never put negative comments in your annotations. Don't say like, oh, I was stupid, I missed this. Oh, I'm so dumb, I fell victim to the shark pattern. Don't do all that kind of stuff. You don't have to worry about swimming with sharks. You don't have to worry about animal patterns. You don't have to be worried about any of those types of things. All you're looking for is liquidity, imbalances, time of day. That's it. That's it. That's all this game is all about. Okay? The algorithm is not going to try to follow some retail logic stuff. It's based on where's the money? Where's the money? Who's the most easy prey right now? And where is the majority of the money? And that's where it's going to run for. That's all it's going to do. And if you strip everything you think you know about the markets away and just give me a couple months, stay with me for a couple months here, and I promise you, you will put everything else down and see it like this. Because this is the truth. This is the perfect understanding of what makes these markets book. That means what makes them go up and down, where they turn, why they go where they go, why are they moving when they move, and why are they arriving when they're arriving at that price point. That's all algorithmic. And it has absolutely nothing to do with ratios. It has nothing to do with anything harmonic, nothing supply and demand zone, nothing to do with Elliott wave, nothing to do with Wyckoff, nothing to do with Gann. None of that stuff has anything to do with it. I literally have just explained exactly what these markets do. That's it. There's nothing else that happens. The buying and selling pressure, it's a myth. Because these markets are going to go higher regardless of how many contracts come in. If they want this thing to go up here, it doesn't require